Hello everybody, just thought I'd take a little look at some chart drawing techniques that I use for you. So we're going to start with silver, and I've had quite a few questions from people just recently about how do you do technical analysis, and people who are perhaps wanting to get started. So this is a software that I'm using at the moment. I'm actually on goldprice.org, and it has the price chart shown for you when you type in gold or silver or whatever you want to look at. You can see the gold and silver prices at the top, and if you scroll down you have a chart here. You can get the same software on TradingView, so click on that window there for you, tradingview.com, and you get the same software with the same sort of tools that you can use for drawing charts. But I'm just using a nice clean blank sort of chart for you with no lines on it at the moment. That's why I'm using this platform. So you can see the silver chart, and what it's showing is that the price spiked in the 1970s up to somewhere around about $50, came all the way back down and then spiked up again in 2011 to around about $50, and then it's come back down, and we've seen a movement upwards in price just more recently. So, but you can see, looking at that chart there, it's all very kind of squashed and not very easy to analyze. So because these moves are vertical, and you tend to get very rapid moves because of the factors that are behind the rise and fall of the price of things like gold and silver commodities, which are measured in dollars, which is a currency which is being created at an exponential rate, then it makes sense to use the logarithmic price chart. And what the logarithmic price chart does is that it compresses the scale so that as you go higher up the price scale, a move of sort of 1 centimeter on this chart covers several dollars up here, whereas a move of 1 centimeter down here covers a few cents. So it's compressing the price action so that it's more I don't know how the word to use really, but it's struggling to find description for what the logarithmic price chart actually is doing, but it's kind of stopping you from getting those huge ridiculous spikes that just go off the top of the chart. So when you do get a price spike, instead of just disappearing off the top of the screen almost, it kind of puts all that into context, more of a context that you can compare, so that you can compare the price action now, and you can compare the price action during those spikes to price action that has occurred previously. So if that makes some kind of sense. Not very good at explaining that, but having got the logarithmic price scale on, you can now see a lot more on this chart. And what you can see, one of the things that jumps out at me straight away, hopefully it does for you as well, is that there's a sort of a cup formation here. I refer to them as arcs quite often, but technically it's a cup and handle formation, for obvious reasons. You can see where it gets its name from. So there's the cup. Just bring the base up a little bit. Takes a little bit of adjustment to get the lines in the right place. And we've got the monthly chart on here at the moment. So each one of these candles, as they're called, is 1 month's price action. Okay, so you end up with a couple of periods where the price just spiked outside of the arc. You can either accommodate them by moving the arc outwards like this, or you can allow them to be sort of price anomalies on the chart. I think I'll just try and show you how you can get the arc to fit all of the price action. So it's something like that. So there's your arc, and when price bottomed and began to move up, the arc supported it here, and it supported it here, but eventually broke through, and in fact what we're forming here appears to be a secondary arc, or a secondary cup, if you want to refer to it as a cup formation, like that. So it's almost a fractal of the larger arc. Fractal just means a repeating smaller pattern within a pattern, with a much clearer anomalous spike during the COVID, when the news about COVID-19 broke. Very quickly the price got back within the arc. So that shows you a couple of things. It shows you how price has a cyclical nature to it. It also shows you that sometimes anomalous things can happen, but the overriding pattern still takes charge and regains control. If I just expand here, something else you might be able to see. Can we put a support line on here? Not really. More so with gold, where you have a handle formation. I think if you can try and draw a handle on here, it would be something like this. There you go. So there's a handle that's formed on the cup, either in the form of that channel or in the form of that secondary cup. But I think you get the idea that what's happened is that the price has been in a big sort of basing formation. It came up in 2011, and it's had a sort of a retrace. It came back from sort of $50 all the way down to, well, in fact, this anomalous low here was not a little bit above $11, so ridiculously low price for silver there, really. But it does feel as though the overall trend is upwards. You look for support lines that support the overall trend pattern, and in silver it seems to be here somewhere. So the support line is around about there. Price briefly dropped below it to confirm the arc here, briefly dropped below it, but closed above it when we had the news about COVID breaking. So it's a steady uptrend. So you could, in a way, you could define the whole price action since 1972 as an ongoing bull market. It depends on how you define things, but you had a much clearer bull market here, bear market here, bull, bear, and now we seem to be getting into a more definite bullish phase. So multiple confirmations, I suppose, that we're moving upwards more acutely, more rapidly at the moment. And you can start looking to the technical indicators as well to give you some corroborating evidence. Let's have a look at the stochastic indicator, see what that shows, and we'll have the triple exponential perhaps as well. Okay. So what can we see from these indicators? What you can see is that there's a steady uptrend in the stochastic indicator at the moment, and when this indicator is in the high zone, price tends to move upwards more rapidly. You see how in the high zone here, where it got into the white area, price shot upwards, and the same thing happened here. As this indicator trended upwards, price started moving more rapidly. That's what's happening at the moment, and you look for a bullish cross, and you might have heard me refer to these in the past, and a bullish cross is where the blue line crosses over the orange line, so the blue line is above the orange line, and that's a good thing. When the blue line is below the orange line and you have a bearish cross, that's a bad thing, putting it into simple terms, really. So and to tell whether you can see actually that the blue line has crossed over the orange line, but another way of telling is by looking at the numbers in the top here, 71.84. If I move the cursor back, 71.85 and 68. So the blue line is above the orange line. So we're in a ongoing bullish phase as defined by that stochastic indicator. Also, the triple exponential indicator is above the zero line, and the zero line is commonly used to signal a bull trend. So if you're above the zero line and rising, it's bullish. If you're above the zero line and the line starts to dip, then you're either in a correction in the bull market, as that was, or you've reached the peak and it's going to reset all the way back to the bottom as it was there between 2011 and 2016. So effectively, we've only just crossed the zero line and we're still rising, so that's a very bullish sign. So this is a positive indicator. This is a positive indicator. We've bounced off the trend line, that's positive. We've got the arc support somewhere in the region of $21, I suppose, somewhere like that. So the downside risk is relatively limited, but the upside potential is significant, particularly if I zoom in, because we've recently formed a yet another bullish pattern. If you're not familiar with the terms bullish and bearish, bullish just means that we're positive, that the price, we're in a positive phase and price is likely to be moving upwards. A bearish phase is when price is moving downwards. So if I change the time view from monthly to weekly, that means each of these candles represents a week instead of a month. And what you can see here is yet another bullish pattern, and it's called a pennant formation, like a type of a flag, So we've had a flagpole, price going up, and then we've had the flag, or when it tapers at the end, it's called a pennant. There's two ways of drawing this. You can either draw it like that, in which case it's more of a flag, and you can actually take the bottom of this candle. You can take the bottom of the candle and draw it more like that, in which case it's a pennant. I wouldn't say either one of those is particularly more valid than the other at the moment. They're both valid chart patterns that are playing out. What I would say, though, is that if you extend these lines like that, they act as support. So we've got three support levels there now. You've got this horizontal line, you've got the declining line, and you've got the arc. And you'll notice that the two dotted lines actually cross here. So that's what, $22.90, close to $23. So if price were to continue downwards, that could act as a magnet and take price to $23 before it bounces up. But because we're so close to the edge of the arc, it would make me wonder if we are actually destined to test the edge of the arc, as we did back here. Look, we broke down through the arc because of the COVID news, but soon got back above it. So, and we've on this time frame, on the weekly time frame, the indicators look slightly different. The stochastic has had a sort of bearish cross, which means the blue line is below the orange line. So, all things considered, there's evidence on the shorter time frame of a pullback, but evidence on the longer time frame of a rising trend. So what? So the jury's out a little bit. I think, on balance, we're going to come back down to either here or to here over the coming month or so. Turn that into an arrow so that you can see it a bit more clearly. I think this is quite a high probability, along with gold dipping down below $1,800. But don't worry, if that's what happens, then all it is a buying opportunity, and this zone here would be a great place to get into silver. As far as the stocks go, the silver stocks, you have to look at the individual mining stocks. Some are very bullish and going up, some less so, and are more likely to track the actual price of silver and drop. In percentage terms, a drop from $25 to $21.50. That's what's that, $3.50. So you're talking about something like a 15% drop, something like that, just working it out in my head. So a 15% downside risk compared to what I think from there would be around about a 100% upside probability, with the likelihood of gains and moves up to around $40 at least over the coming sort of 3 or 4 months. Okay, so I'll leave it there for now. I think I'll be doing more of these tutorials, I think, over coming weeks if you like them. If you think they're useful, if you find them helpful, just put something in the comments and let me know, and I'll do more. And if there's a particular chart that you want me to look at, I can do that as well. So thanks for listening, and I hope you enjoyed that.